Hey everyone, it's Noel Christopher, Chief Real Estate Officer with Evernest, coming to you with a video. Been a little bit since I did a video, but here we go. There's a lot of things that are happening in the real estate markets, and there's what I really want to talk about is that there's so many different opinions that aren't data backed, or some that are partially data backed about what's happening with the housing market. And this is how I see it. But first, I listen to a lot of different opinions and read a lot of different data points that are summarized, and I'm never pretend to be an economist, but you could listen to guys like Logan at Housing Wire or Mark Fleming at First American that are more bullish on the housing market, maybe not bullish on the overall economy and the state of our country, but more bullish on the housing market in a certain sense. Or guys like Wolf Richter from Wolf Street or Nick Jurley from Reventure Consulting that are more the sky is falling philosophy, which I really firmly believe that they use some out of context data to fulfill their narrative. And then you have all of those have the recency bias that are somewhat of armchair quarterbacks who just kind of throw out there like, if it goes up, it must come down philosophy, or looking at just certain little data points like median home price or what just Phoenix is doing relative to last year, rather than looking at, for example, where's inventory on a 10, 20-year trend, compare it instead of just looking at year over year. So there's all these different things happening, but here's how I really look at it. Until there are, and this is now getting into about rates and mortgage rates and the 10-year treasury bond, which really drives that 30-year mortgage rate. What we saw was back in January, rates went down to about 6. A lot of home buyers flooded into the market to buy. Sellers said, great, let's sell. Things are taking a turn for the better. And that's why you see the most recent data that's looking back in January saying that, there was a decrease in inventory, increase in home sales, all these different things happening, but rates went back up to 7. The Fed really looked at, and what they saw was that inflation was still going up. They're still tightening. That kept the 10-year treasury, which is still under 5, as Logan likes to point out a lot, but it's really not getting down to that lower number. Rates could still go up. The big reason for all of this is that we're not seeing job losses, and the Fed's been pretty clear until they see loosening in the job market, they're going to continue to be very aggressive. And so any of you think that mortgage rates or interest rates are going to go down anytime soon, 2023 is not looking like it may not happen. Unfortunately, we have to wait until we see some more job losses. And so that's really what's really driving everything. You've got record low inventory. I mean, really close to record low inventory in most of the markets around the country, or some of them gotten back to normal inventory. But there isn't a flood of people selling their homes. Unless they absolutely have to, they're not going to sell their homes. And you may talk about layoffs. Well, if you look at it, history is average layoffs per month in the United States. Layoffs or job firings, however you want to look at it, is around 1.5 million a month. We're not even hitting that numbers. We're at actually, historically low numbers of people being laid off. So stop looking at the headlines. You see a lot of these companies that may announce layoffs, or stock prices jump. They may lay off some overseas staff, or they may lay off contract workers or whatever, but that's really not, the layoffs aren't really affecting anything yet. So until we start to see, unemployment filings getting up into that 300,000 range, which we're not even close to that, you're not going to see the Fed doing a whole lot. What caused a lot of this was a record amount of money being pumped into the system, which kept rates really low. And a lot of people really pushed up house prices because of, basically free money. And so that's a very, very arbitrary way to look at it. But, we really want to break it down. So the point is that we're not going to see this huge decline in house prices. Yeah, house prices have been going down, rents have been trending down. You still have the CPI numbers, you still have the owner equivalent rent numbers that are still showing much higher rents and shelter costs than there really is. But we're not seeing a lot of things unstick. So we're kind of in the status quo for a little while. Now, when we talk about what's going on with what we're doing and and a lot of people putting their homes for rent, and there's still a lot of people that need a place to live. Maybe some of them have pulled back, but you still have a lot of people that need a place to live, and if they can't buy a house, they're gonna have to rent a house. So we're very bullish on the SFR market. In fact, this is the first time in history recently that there were more single-family rental homes being built than homeowners, or new construction homes. I apologize. So that market is also very controlled. You have the home builders controlling their inventory they're putting out. They're working with investors more than they used to because they're realizing the benefit there. And so there's just a lot of things happening. So hopefully I'm not going to disappoint all of those who have the recency bias from the last crash, or they think that just housing prices are going to just crash. Have we hit a bottom yet? I probably would have thought we did a few months ago or a month ago, but maybe we haven't. There's a little bit more to go in some markets, but there isn't this wholesale crash. So again, same thing I've been saying for a long time. Just saying it a different way. And hey, you're welcome to go read and listen to as many people as possible that are smart. Just really realize that data can be taken out of context so quickly and so easily. So just be cautious there. Thanks.